Okay, here in this video, we continue our discussion of AUC Section 240 regarding the consideration of material misstatement due to fraud and a financial statement audit. And up until this point, we've held discussions with management, board of directors, and others within the entity to get information about their fraud policies. Then we assess the risk that there is fraud at the company. And based on that assessment, we developed our responses to that risk. And through responding to those risks, we have finally obtained some audit evidence related to those risks. And so in this particular video, in AUC section 240.34 through 37, we will discuss how to evaluate that audit evidence in relation to the risk of material misstatement due to fraud. So first we see here that we should evaluate at or near the end of the audit whether the accumulated results of auditing procedures affect the assessment of the risk of material misstatement due to fraud that we made earlier in the audit, and whether that indicates that there are previously unrecognized risks of material misstatement due to fraud. So after we've done all of our procedures in the audit, as well as our analytical procedures that are required in paragraph 22 above, we need to assess the evidence that we've obtained and see if there's any further risks that we didn't consider earlier in our planning process. And if there's any further risks that we didn't foresee, then we should respond to those appropriately according to the other sections that we've gone through so far. And also, if we identify a misstatement during our audit, we should consider whether that misstatement might be indicative of fraud. And if we do think that that misstatement was due to fraud, we also need to think about other areas in the audit that it might be related to. For instance, if management and employee integrity is now flawed, since we've found this fraud somewhere else, we might consider other places where integrity, the management's and employee integrity being low might cause fraud or misstatements in other areas of the financial statements. Because these pervasive characteristics would mean that it's likely not an isolated occurrence. So we also see here that when we identify a misstatement, whether it's material or not, we still need to consider whether management is involved and reassess our risk of material misstatement due to fraud and its effect on our nature, time, and extent of audit procedures to respond to those risks. And because as we discussed before, if it involves management, it's likely not an isolated occurrence. And even though this misstatement might be immaterial, since management's involved and it's likely not isolated, then there may be more material misstatements elsewhere that we haven't considered before. So I might consider whether collusion is happening involving employees, and that's where several employees get together to perpetrate a fraud together. And if we end up concluding that, or we're unable to conclude whether the financial statements are materially misstated as a result of fraud, then we should evaluate the implications for our audit and maybe consider withdrawing or who we need to report that information to. So we've got a lot of explanatory material here, starting with 57 and going all the way down to 61. So let's go down to the explanatory material and get some more details on how to accomplish evaluating the audit evidence that we've obtained. Okay, so now we're down to the explanatory material related to evaluating our audit evidence as it relates to our fraud risk. So if you remember, we're required to perform analytical procedures around the end of our audit to make sure that everything looks reasonable and that we don't really have a risk of material misstatement due to fraud, or rather that risk is down to an acceptable level. And this requires our professional judgment. And this is different than the analytical procedures that are required as part of our planning process in the audit. This is at the end of the audit where we're assessing the accounts and relationships and after the adjustments that we've made to make sure everything looks reasonable based on our understanding of the company. And in particular, the AUC sections really hone in on revenue as being a big fraud risk. And so they suggest watching out for uncharacteristically large amounts of income being reported in the last few weeks of the reporting period, or unusual transactions or incomes inconsistent with trends in cash flow from operations. So in our revenue analytics and also maybe gross profit analytics, we would see if we have it disaggregated by month, we would be able to see if the entity is maybe pulling revenue from next year into the current year when they shouldn't be. So some examples of some unexpected analytical relationships that we might identify could indicate a risk of material misstatement due to fraud are listed here. And there's some relationships that are generally unable to manipulate, and that might help us to identify fraudulent information. So a few examples of those here. First, the relationship of net income to cash flows from operations might appear unusual because management may have recorded fictitious revenues and receivables, but they're not able to manipulate cash. So the entity might be showing a whole lot of net income, but there's not a whole lot of cash flow related to that income, so that might be suspicious. There might be some odd changes and relationships of inventory to accounts payable, sales, or cost of sales, because if an employee is stealing inventory, it would be difficult for them to manipulate all of the related accounts to that inventory, unless there was some kind of collusion or they're able to access the journal entries and journal ledgers and such. So really different changes and odd relationships in these accounts might indicate some kind of fraud. We might compare the entity's profitability to industry trends. If there's an odd relationship between those two, then it might be indicative of fraud because management can't manipulate the industry trends. All they can manipulate is the entity's profitability. So if it looks like the entity's way more profitable than the industry, unless we can find a good reason for that, then that might be some kind of fraud occurring. And as another comparison to industry data, which management can't manipulate, maybe bad debt write-offs might not be comparable. And so that might be indicative of an employee stealing cash receipts. So, for instance, if a customer pays off their receivable, the employee pockets that payment and then writes it off as a bad debt rather than receiving the cash and writing off the receivable. And here we have an example of a relationship between financial data and, or rather, comparing sales volume to production volume. So if it looks like we sold way more products than we produced, that would be pretty odd and might be something that management can't manipulate, or at least make them appear to have a reasonable relationship without affecting other accounts. So these are a lot of good examples for us to look at in our analytics to identify any risk of material misstatement due to fraud. Next, after we've performed the audit and we've identified some misstatements, we want to understand how those misstatements happened and whether it was due to a fraudulent activity. And that's because typically, if a fraud has happened, it's most likely not an isolated occurrence. There's likely fraud pervasive through the financial statements. And so when we have misstatements, we need to understand if they're related to fraud. That way, we can understand whether there might be a risk that other accounts in the financial statements are misstated due to fraud. And as we mentioned above, insignificant fraud, an immaterial misstatement, might still be significant to us if it involves senior management, because then that might look poorly upon senior management's integrity and give us reason to believe that maybe there are misstatements due to fraud elsewhere in the financial statements also. It also leads us to question whether the information or evidence that was given to us is complete and truthful, and also maybe whether there is collusion between employees, management, or third parties. So if we find a fraud occurring, no matter how small or insignificant, we need to assess whether it involves senior management. If it does, we really need to question the entire audit. And a lot of this information comes from other AUC sections. For instance, Section 450 and 700 address the evaluation and disposition of misstatements and the effect on the auditor's opinion and the auditor's report. So these sections will go hand in hand with this information related to analyzing the misstatements that we found. Also, AUC Section 580 regarding written representations addresses obtaining appropriate representations from management in the audit. This is important because management acknowledges its responsibility for the internal control to be designed, implemented, and maintained in order to prevent and detect fraud. So it's not necessarily our responsibility to prevent or detect fraud, it's management's responsibility. As we've seen in other AUC sections, it's our responsibility to identify material misstatements that could be due to fraud.